Dubai's property market crossed an estimated $400 billion in value. Luxury sales kept breaking records through 2024, and cranes still dominate the skyline. But beneath the glass towers and billion-dollar launches, analysts began noticing something uncomfortable by early 2026. Transaction momentum in some segments appeared to slow. Investor conversations changed, and some developers quietly became more cautious with future supply. The city still looks unstoppable. That's exactly why the shift matters. For years, Dubai became one of the world's most convincing economic success stories. By 2024, the Emirates' economy expanded by roughly 3 to 4%, depending on the sector measured. The population moved beyond 3.7 million people, and luxury real estate sales surged to record levels. Waterfront mansions on Palm Jumeirah sold for over $50 million. Branded residences exploded across the skyline. More than 17 million international visitors entered the city in 2023 alone, helping reinforce the idea that Dubai had become a permanent global hub for wealth, tourism, and capital. Everywhere you looked, the signals felt strong. New highways, new financial districts, new mega projects stretching into the desert. And for investors, the story felt almost perfect. Income tax, aggressive infrastructure expansion, continuous foreign capital inflows, a luxury market that seemed capable of absorbing almost any level of ambition. Even in uncertain global conditions, Dubai appeared to move faster than everyone else. That was the dream. The problem is that systems built around rapid expansion often look strongest right before subtle pressure starts building underneath them. By late 2025 and early 2026, the first cracks did not appear through dramatic collapse. They appeared through behavior. Some brokers began reporting longer sales cycles in parts of the luxury market. Investors who once rushed into off-plan launches started asking more questions about supply, delivery timelines, and future resale demand. In certain districts, listings stayed active longer than they had during the peak momentum phase of 2023 and early 2024. The skyline still looked full. Showrooms were still operating, but the emotional tone underneath the market had started shifting, and there were visible signs too. Reports indicated Dubai could see more than 200,000 additional residential units delivered over the next several years, with large portions concentrated in premium and luxury categories. At the same time, construction costs remained elevated globally due to labor, logistics, and material pressure that had persisted since the post-pandemic period. Some developers responded by becoming more selective with launch timing. Others increased incentives quietly instead of lowering headline prices directly. That matters because markets like Dubai are heavily driven by confidence and momentum. Once urgency slows even slightly, the system becomes more sensitive than it appears from the outside. And this raises a difficult question. Is Dubai experiencing a normal stabilization phase after explosive growth? Or are these the early signs of a market beginning to strain under its own scale? Over the past several years, billions of dollars in foreign capital flowed into Dubai real estate. In 2024 alone, transaction volumes reached record territory, with total property deals exceeding hundreds of billions of dirhams across residential, commercial, and luxury segments. Wealth migration played a major role. High net worth individuals from Russia, Europe, India, Africa, and parts of Asia moved capital into Dubai, seeking stability, tax efficiency, and global mobility. But while demand surged, supply accelerated even faster. Reports and development pipelines suggested that more than 200,000 new residential units could enter the market between 2025 and the end of the decade, including a heavy concentration of luxury apartments and branded residences. And that changes the equation dramatically. Because markets can absorb high prices more easily than they can absorb oversupply. By early 2026, some analysts began noticing that price growth in certain premium areas appeared to slow compared to the explosive gains seen during 2023 and 2024. Not collapse. slowdown. And psychologically, that distinction is critical. Investors who entered expecting rapid appreciation suddenly faced a different environment, where holding periods might become longer and resale liquidity less certain. At the same time, cost pressures remained elevated. Construction financing became more expensive globally due to higher interest rates. Labor and material costs stayed above pre-2020 levels in many regions. Developers therefore faced pressure from both directions: continued expansion expectations on one side and rising execution costs on the other. Then came the demand shift. Some buyers still viewed Dubai as one of the strongest global luxury hubs available, but others started behaving differently. More negotiation, more waiting, more comparison shopping across projects. In previous years, fear of missing out dominated the market. By 2026, parts of the market appeared increasingly driven by fear of entering too late. And once that psychological transition begins, momentum-driven systems can become much more fragile than the skyline suggests. For many residents, the shift stopped feeling theoretical long before it appeared in market analysis. Between 2022 and 2025, rents in several Dubai districts increased dramatically, with some areas reportedly seeing apartment rents rise by more than 30 to 50%, depending on location and property type. Families who originally moved to Dubai for opportunity suddenly found themselves recalculating everything. School fees increased. Service charges climbed. Everyday living costs became heavier, even as the city continued projecting luxury and expansion. In some neighborhoods, long-term tenants were pushed out entirely as landlords repositioned units toward higher-income renters or short-term luxury demand. And that created a strange contradiction at the center of Dubai's growth story. The city was becoming wealthier, more global, more exclusive, while simultaneously becoming more difficult for many middle-income residents to comfortably sustain long-term. You could see it in behavior: shared living arrangements, longer commuting patterns, quiet conversations about relocation to cheaper Emirates or different countries altogether. The skyline still looked futuristic. Restaurants were still full. Luxury launches still dominated headlines. But underneath the visible prosperity, pressure was spreading unevenly across the people actually living inside the system. And historically, that matters more than many investors want to admit. Because property markets do not survive on luxury buyers alone. They also depend on whether ordinary professionals, workers, and long-term residents can continue supporting the broader economic ecosystem underneath the towers. Several forces appear to be driving the pressure now building underneath Dubai's property market, and none of them alone seem large enough to break the system. That is what makes the situation more complicated. The first cause is supply acceleration. During the explosive growth phase between 2022 and 2025, developers responded exactly the way fast-moving markets usually respond. They built more. More towers, more branded residences, more waterfront projects. But large supply pipelines create delayed pressure because units continue entering the market years after the original demand surge begins. The second cause is global liquidity. Higher interest rates since 2022 changed investor behavior worldwide. Capital became more selective. Safer assets suddenly started offering stronger returns again, which reduced the urgency to aggressively chase luxury property appreciation. The third cause is psychology. During peak momentum, many buyers entered the market expecting rapid price growth and fast resale opportunities. But once appreciation slows even slightly, investor behavior changes quickly. Urgency disappears. Negotiation increases. Holding periods become longer. And markets built heavily around confidence feel that shift immediately. The fourth cause is affordability pressure inside the city itself. Rising rents, school fees, and living costs have created stress for middle-income residents, which affects long-term economic stability underneath the luxury layer. A city can attract billionaires and still face structural pressure if too many ordinary professionals struggle to remain comfortably inside the system. And finally, there is the expectation problem. Dubai spent years building a narrative of unstoppable growth, luxury expansion, and future ambition. But systems built around acceleration eventually face a difficult reality. The faster expectations rise, the harder they become to sustain indefinitely. And once investors begin questioning sustainability instead of chasing momentum, the emotional foundation underneath the market starts changing very quickly. To be fair, there is still a very strong argument that Dubai remains one of the most resilient property markets in the world. The city continues attracting global wealth at an extraordinary pace. Infrastructure investment remains aggressive. Population growth is still positive. Compared to cities like London, Hong Kong, or New York, some investors believe Dubai luxury property still offers relatively attractive value, especially given tax advantages and international mobility benefits. And historically, Dubai has repeatedly shown an ability to recover faster than many critics expected after previous slowdowns. That side of the story is real, but the opposing view is becoming harder to ignore. Rapid supply expansion, rising living costs, more selective investor behavior, and slower momentum in certain segments are all signals that the market may be entering a far more sensitive phase than the headlines suggest. Not collapse, sensitivity. And in highly confidence-driven systems, sensitivity can matter more than visible weakness. Once enough investors stop believing prices will rise quickly forever, the emotional engine driving aggressive buying begins cooling underneath the surface. So now Dubai sits in a strange position. The city still looks globally powerful, yet some of the behaviors underneath the market increasingly resemble a system trying to manage the consequences of growing too fast, too successfully, for too long. And this creates the decision trap now facing investors, developers, and even long-term residents across Dubai. Staying in the market still carries enormous potential upside. If global wealth migration continues, if tourism remains strong, and if Dubai successfully absorbs future supply, today's concerns may eventually look like temporary growing pains inside a city still evolving into a dominant global financial and luxury hub. Investors who exit too early could miss another major expansion cycle. But leaving or reducing exposure carries risk too. The market truly is becoming more fragile underneath the surface, then holding aggressively through a period of slowing momentum could become increasingly uncomfortable. Luxury inventory may take longer to absorb. Returns could normalize after years of explosive growth. Financing pressure could rise if global liquidity conditions remain tight. And for ordinary residents, the trap feels just as difficult. Staying means accepting rising living costs and increasing pressure on affordability. Leaving means giving up access to one of the fastest-growing economic ecosystems in the world. That is what makes this moment psychologically dangerous. There is no obvious answer anymore. The same city that still looks unstoppable from the outside is now creating very different calculations behind closed doors. What is happening in Dubai may also reflect a much larger global shift in the way wealth behaves during uncertain periods. Over the past decade, capital increasingly concentrated itself into a small number of safe growth hubs, cities capable of attracting international money, luxury demand, tourism, and high-income migration simultaneously. Dubai became one of the clearest examples of that model. But as global conditions become more unstable, wealthy investors appear to be changing strategy. Instead of chasing pure expansion at any cost, many are becoming more focused on flexibility, liquidity, and optionality. That changes luxury markets everywhere. High-end real estate is no longer viewed only as a lifestyle purchase or prestige asset. Increasingly, it functions as part of a broader capital preservation strategy tied to geopolitical risk, taxation, mobility, and long-term uncertainty. And that means cities like Dubai are now competing not just on growth, but on resilience. This is the deeper shift beneath the property story. The age of easy momentum may be fading globally. In its place comes something more cautious, more selective, and potentially more unstable psychologically. Capital still moves, wealth still concentrates, luxury still sells. But investors appear increasingly unwilling to assume that endless acceleration is guaranteed forever. And once that mindset spreads, even the world's most ambitious markets begin behaving differently. Dubai's property market may still be worth hundreds of billions of dollars. The skyline still shines. Luxury launches still happen. Billionaires are still buying waterfront mansions and branded penthouses. From the outside, the system still looks powerful. But beneath that surface, behavior is changing. Investors are becoming more selective. Residents are feeling more pressure. Developers are managing growth more carefully. And that may be the real signal hidden underneath the optimism. Because markets rarely crack all at once. They usually begin with subtle shifts in confidence that most people ignore until the cycle already changed. So this raises a difficult question. Is Dubai simply evolving into a more mature global property market after years of explosive growth? Or is the city beginning to experience the first consequences of a system that expanded faster than its foundations could comfortably sustain? And more importantly, if you were investing today, would you still chase the dream at full speed? Or would you start becoming more cautious too?